Hi everybody and welcome along to the Mint monthly update for these single sector funds. We'll be looking at what happened in July with myself and fellow portfolio manager John as well with us today. And starting with the key driver for the market for the month, unsurprisingly, it was the central banks and especially our central bank indeed. And I guess looking at the chart here, going into the month, the dot plot at the top is the RBNZ's expectation, to be fair, a little bit old. And then we saw at the start of June, the track that we'd expected, and we saw a pretty significant repricing of the OCR over the month, and that of course was driven by a couple of key data points. One being a lower CPI read, again came in at 3.3, below the RBNZ's expectation of 3.6. But also we had an NPS update from the RBNZ where they kept rates flat, but of course the tone was certainly dovish. And that got the market rather excited, and we saw a repricing, a pretty significant move. And again, there were some sort of cautions around when we see cuts from the RBNZ, basically around the non-tradable inflation, which is still sitting above 5, and something the RBNZ we know is particularly focused on. But I guess more recently, we've also seen unemployment came in the other day at 4.6%, ticking up, of course, slightly below consensus, and hence what we've seen is over the month of July, and it's now we had seen a cut price in August that's now been half unwound, so we'll see if it's August or maybe October. But certainly we are seeing 3 cuts in price for the market by November, so certainly that'll be a key driver for the market. Now for the July and the month that was, it was a very strong market for New Zealand equities. Obviously New Zealand had been behind the international curve for a while, and we saw it bounce back solidly, and again, as we've noted in the past, rate movements and expectations of them will be a key driver. Now, the near 6% increase was strong across the board, but it was a little bit of an unwind of what we've seen in the past. So we certainly saw the smaller mid caps outperform versus the large caps as people look to rotate and change some positioning. Some of the key names for us are around Somerset and THL, some of the ones that had performed a little bit poorly in the past. But I guess one of the key features of the month was retirement, as we saw a bid come in for Arvida. We'd had one not crystallised earlier in the year, and again this one was been accepted and has been supported by the board, and it was at $1.70, so a good 65% above the current share price, and interestingly at a 0.8 times NTA, which is something that is often focused on, and then again in previous takeovers has been said they won't accept bids below NTA, but as we see now, I think the understanding and the actual realisation of what NTA means is becoming a bit more realistic. We also saw Oceania Healthcare also rally strongly, almost up 50% in the month too, as it was seen as almost the next cab of the rank in terms of M&A, but also a recovery from its prior weakness. We sort of think that OCA has a potential chance of a takeover, but at the lower probability end, so we don't think we'll see anything too soon from there. But I guess the other name that was interesting, that saw a fleeting bid that's disappeared already, was the Warehouse. They had a strong month, as you can see in the chart on the right there with the other retirement names, with a bid from its founder, so Stephen Tyndall, as well as an Aussie private equity firm, but that has been quickly shot down by the board, so not likely there at the moment. Obviously, that consumer businesses like a lot continue to struggle. The one update we did get in the month was from Mainfreight in terms of their AGM. Now that was an interesting one. There's a bit of expectation of are we starting to see a recovery in earnings? The answer was no. While it was, rebasing transport, the key division for it was relatively flat, but its warehousing and air and ocean were actually a little bit disappointing, not on revenue, but more so on margins, as freight rates had rebalanced themselves. We are seeing the outlook for freight rates better, so we do expect a better second half from this business. And also from a warehousing perspective, we know that they've got new facilities online, and utilisation is a little bit low, and as we know, and freight volumes activity is a little bit less at the moment, so we expect that to improve too over time. And geographically, New Zealand was okay and not particularly bad, but Australia was actually quite strong. But looking at the Mainfreight business offshore in Europe and the US, where they are more subscale, certainly struggling, and an area we sort of hope to see some improvements over the next while. Just quickly before I go on the results coming in August from the local names, I think we'll see a reasonably cautious outlook. I don't think we'll get any sort of strong upgrades or even confirmations of outlooks. We might actually get minimal detail on numbers, but a few of the ones we're still cautious on are the domestic cyclicals again. I think names like Freightways, we're sort of interested to see if we are seeing any recovery there yet. Feels unlikely. but also even names like Air New Zealand, even Spark with some government exposure and mobile to the consumer. But even the other classic cyclicals like Fletcher Building, we're keeping a close eye on. And as you'll be aware in the media, with high electricity prices at the moment and gas, of course, high energy users could be struggling and seeing some pretty painful power bills coming through in the next while. So we are being cautious of some of those too. Quickly on the flip side, I guess A2 and some of the names that we believe will have good top line growth might do quite well. There's a bit of expectation within that one, but we actually think that as a top line, we'll see some good numbers out of A2 on the formula space, but are a little cautious overall as we saw a pretty poor marriage print, which is a good indicator of birth rates in China. So we are being a bit realistic of what we expect in the near term on that name. So I'll pass over to John.
Thanks, Dave. Moving across to the Australasian Equity Fund. Again, strong markets. Interesting enough, for the first time in a while, New Zealand outperformed Australia by basically 1.5% plus. So a little bit unusual there, but we don't want to cause any issues with that. And again, similar themes, basically a decent bounce in cyclicals and those with balance sheet pressures funded by selling of quality growth names. In addition, we got a bit of technology selling, basically because the US reporting season was on the soft side, in particular a couple of earnings misses and also signs that CapEx is going to be higher for longer on the AI theme. So, for the fund, almost a perfect storm for us in terms of a low quality bounce versus our preference for higher quality growth names. And so, to be honest, we were quite happy that the fund held on in the way that it did. Looking at the good news, obviously, Dave's mentioned retirement sector, and we've got a decent overweight in Somerset, which helped us in the month. Clearly, unfortunately, the flip side was not owning the mid-cap Arvida in particular weighed on the fund, and then we sort of underperformed slightly. On the back of the changing rhetoric at the RBNZ, we have driven a few changes within the fund. In particular, we have actually bought a bit more of the retirement sector, as we see that's the best way to play interest rate cuts. And again, on the bottom left, you can see we have moved things around a little bit. Just focusing on the chart on the right, I quite like this sort of GARPA hype cycle, and again, in particular, looking at the AI cycle currently. Basically, I quite like the names and sort of the rhetoric, but what happened in the month? Well, I think the rhetoric behind AI probably peaked. And sentiment started to unwind slightly, again, for various different reasons. The reality is we're still focused on the picks and shovels, the data centers and the pipes, which I think will do well out of increased data use, come what may. But I think the market has been started to take a slightly less sanguine view about AI service revenues going forward. And I think that drove some of the sell-off in the States, which moved over to Aussie as well. Moving across to the property fund, again, similar theme, a very good month for the sector. It's interest rate sensitive and hence had a very nice bounce. Again, what bounced highest? Basically those with concerns about balance sheet and greater cyclicality. So again, we did lag slightly, but we're pretty happy in the grand scheme of things with how we performed. Positives and negatives, basically, Somerset holding across most portfolios did very well for us, and some of the asset managers in Aussie, so Charter Hall, had a good bounce. In July, actually, NextDC gave back a little bit of the outperformance that it's delivered in recent months, and that was the main way on the fund. And obviously, the higher quality names such as Goodman Group and GMT also came under a little bit of pressure. But again, nice to see the sector as a whole having a strong month, having been an underperformer in recent months. Looking to the chart in the right, I mean, for me, this is sort of highlights the slight quandary we have in the office side of the market at the moment. This is basically the Dexus office portfolio in Australia. And essentially says that the cost to replace the numerous assets which are in the slide is essentially 20 to 30% higher than the cost they're currently, their book value current. For me, that is sort of the bull case in the sector, but shouldn't really be taken in isolation. Yeah, clearly the cost to build is high. For me, the implication for that is, well, you shouldn't be building at the moment. But as sort of rents grow gradually over time, I think we will pick up that sort of undervalued rents or that under-rentedness within the sector. The thing this slide doesn't really focus on is office vacancy and new product entering the market. In New Zealand, basically, there's not a lot coming. The market's pretty static. In Sydney and in particular, there is a lot of new office build coming to the market over the next 12, 18 months. And hence, the office side of the market remains challenging, particularly when we are giving 30 to 40% incentives to, when we do re-rent office space, which clearly weighs on sort of cash yields. So for me, office is still tough. We're keeping an eye on it, but I think the reality is that the problems will take a bit of time to solve, particularly in Sydney, and hence we are happy to be sort of still underweight office to some extent. Vacancy is the clear thing to be keeping an eye on, and we will. And if that changes or improves, clearly we'll be ready to move the portfolio in that direction. So that is the end of the update. As usual, thank you very much for your support. If you do have any questions, please drop us a line at info@mintasset.co.nz. Otherwise, thank you, and we'll speak in a month.